before 1913, there was no currency as we know it. There was no generalized inflation for 130 years there. And then, of course, once we started the Fed, which was in 1913, the government started to monopolize money. In the next 120 years or so, we've had huge inflation. I think the price level has increased 33-fold. It's just another example of how government shouldn't be in the business of doing what the private sector does better. There should be no government money. There should only be private money today, and it should not be run by Powell. I mean, what? I mean, this guy's not competent, and government shouldn't run money. It should be private.
Hi, Bob.
Hey, Adam.
Buddy, I am so excited. You want to know why?
Why?
Because as much as I love doing clip shows and as much as I love reviewing movies and books and graphic novels, when I have a bona fide economist to talk to, I really love talking about economics, and that's what we're going to do today.
Yeah, I'm excited as well. I thought you were going to say that you can kind of phone this one in, and I'm going to do most of the talking.
Also that.
Yeah, it's a twofer.
So why don't you tell us why we are taking this opportunity to talk about economics?
Sure. So the news hook here, folks, is a recent interview dropped from the Hoover Institution of Arthur Laffer. So of Laffer Curve fame, and I think we'll get into that later in this episode, what that is and so forth. And I have a special insight into Laffer's work because I used to work for him. So after, get my timeline right. So I got my PhD at NYU, then I taught at Hillsdale College for 3 years. And then we ended up in New York. And then the next job I had, moved down to Nashville, and I worked for Arthur Laffer for just shy of a year. And so I got to, immerse myself in his academic work, and I saw, how he wrote his research papers for his clients and things like that. So anyway, I am pretty well versed. And also I will say, for those of you who are Austro-libertarians, I'm sure many of you are, partly what I'm going to get into in this discussion is the aspects of Laffer's worldview that things I picked up from him, right? That I did not know just from reading Man, Economy, and State and Human Action. All right, let's put it that way. So that's kind of just the preface. So again, what we're going to show clips from is this younger guy at Hoover asking Arthur Laffer a bunch of questions, and then he just goes off and tells war stories and things like that. But I think those of you interested in economics and the history of economics will appreciate this.
Absolutely. So I watched the interview, and we're going to play 3 clips from it, and then I have a bunch of follow-up questions. Why don't we just launch right into the clips? Do you want to tell us why you picked this particular first one, or does it need any setting up?
Yeah, ultimately, what's going to come across in this first clip is Laffer's pretty strong about the money should be left to the private sector. And it's interesting just because I think some Austro-libertarian types have this idea that, Art Laffer, he's kind of an establishment guy or something. And I know Murray Rothbard had a critique of the Laffer Curve and, at one point. So anyway, this just may surprise you. So I partly wanted to include this one just so people could see that this is what Laffer's saying when Hoover's interviewing him right now.
Yeah, I'm glad you picked it. Surprised me. All right, here we go, folks.
It was before Schultz Treasury that I'm talking about. Here he was head of the Office of Management Budget. His first job was Secretary of Labor. And then when he moved over to be head of the Office of Management and Budget, this newly created agency, is when I joined him in 1970. Now, at that time was just before the Camp David wage and price controls, devaluation of the dollar, the 10% import tax surcharge, all the stuff you and I hate and despise and disagree with to the limit. But Nixon, I enjoyed Nixon personally very, very much. But this was George Shultz's first thing there. And then, of course, what he did was he left that. He went become Secretary of the Treasury. And I went with him for that. I was his consultant 2 days a week from the University of Chicago. I went in there, and I had my own little office right next to his, right across the little hall there. And it was just a cool, cool time. That's when we went off gold, when we devalued the dollar. We did all the Smithsonian Accord. All of that stuff occurred in that period. And it was a very exciting period, a very, in my way, bad period in sense of economics. I mean, it's when government finally monopolized money. As you know, John, before 1913, money was private. There was no government money. Now, the government did do three things. It defined what a dollar was. It's 1/20th of an ounce of gold. It's 1 ounce of silver. That's what they defined that. Then the government also, prior to 1913, did have a mint that minted coins. If you brought in bullion, it minted coins correctly and charged a fee for it. So did a lot of other places mint coins. And the third thing the government did, which was really important, was that it audited banks' balance sheets. So if you said your balance sheet and your income statement was such, they went in and audited it, made sure it was true. And what was before 1913, there was no currency as we know it. There was banknotes, which were issued by individual banks. Some sold a slight discount or premium to another bank or so. But that was the money back then. And obviously from 1790 until 1912, let's say, the U.S. had bibbles and bobbles and inflation, but there was no generalized inflation for 130 years there. And then, of course, once we started the Fed, which was in 1913, the government started to monopolize money. Then Roosevelt devalued the dollar from $20.67 an ounce to $35 an ounce. Interest equalization tax, voluntary for increase, ending up in the Smithsonian. In the next 120 years or so, we've had huge inflation. I think the price level has increased 33-fold. It's just another example of how government shouldn't be in the business of doing what the private sector does better. There should be no government money. There should only be private money today, and it should not be run by Powell. I mean, this guy's not competent, and government shouldn't run money. It should be private.
Yeah, I was surprised when he just went out and said that. Is that what he would have said when you knew him back when?
I mean, I was surprised too. So I guess that's one way of saying I don't think so. I think that was like a stronger statement from him. Also, I was surprised by him kind of making fun of Powell there at the end, because his style typically, again, when I worked with him, so just to give people, that would have been 2006 to 2007, in that area, that range. He was very, how am I trying to say? He was more courteous to people. Like, you might just say, oh, he's a right-wing guy. And so, oh, geez, Al Gore, let's go make fun of Al Gore. Because Al Gore lived in Nashville. And Laffer was not, didn't make fun. In fact, Laffer gave like qualified support for a carbon tax, saying as long as we use the revenues to reduce income taxes, I could support that. In other words, he was trying to say, instead of us just sitting in the corner and saying, oh, it's all a hoax or something, let's try to work with these people. And anyway, I'm just saying, he made it his policy, at least, when I worked with him at that point, that like, no, if a Democrat wins, I'm not going to trash them, because, if they want to take my advice, I'll talk to anybody and tell them, with the supply side economics and blah, 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 right? I'm not partisan. So anyway, I was just saying, in that clip, among other things, I was kind of surprised with the shot he took at Powell there. But yeah, specifically, it was interesting, because what's funny is I think a lot of Austro-libertarians would not say, oh yeah, we had private money up through 1912. Mm-hmm. And then even there, and then he was only seeing the government fully, exerted its monopoly over money not until 1971. So let me just explain to people what Laffer means. Okay. And again, the reason I thought that was cool is that he, showing his familiarity with like the monetary history of the United States and the way he's classifying it. So I say this a bunch. I'll keep this brief, Adam. By the way, folks, where you can get all this stuff is my book from the Mises Institute, Understanding Money Mechanics. I lay all this stuff out if you want to see more of it. But the reason I stress this, Adam, is because I used to misunderstand. I thought that, under the classical gold standard, like before the Fed, let's say like 1912, 1910, I thought the U.S. authorities still issued dollar bills, but that they were backed up by gold. And that's not what it was. It was more hardcore than that. That, for various periods of U.S. history, when there wasn't a central bank, there was the Bank of the United States, second bank that Andrew Jackson killed, and then eventually the Fed. But in those interim periods, or to go the other way, from 1792 up until the eve of the Civil War, the U.S. federal government never issued paper notes that purported to be official U.S. dollars. What they did is they defined a dollar as certain amounts of gold or silver. Like a silver dollar coin had such and such, grains of silver. A $quarter had 1/4 that, that kind of thing. Or a $10 gold eagle piece had this many grains of gold. And a $20 double eagle had twice as many, that kind of stuff, right? So that's how they defined those coins. And then people would just bring the raw gold and silver to the mint and get it stamped into the coins. And that was the lawful money. And then, if you wanted to have pieces of paper, you would go to regular commercial banks and you'd, give them 10 silver dollar coins that, had some heft to them. They were serious pieces. And then they would, give you 10 single notes or a $10 note. And that was a claim on that bank. That wasn't, the U.S. government didn't print that note. All right. It was not. So when the Fed comes along, this is what Laffer's point was. He's saying that whole system got displaced. And then what is the Fed? The money, the currency in your wallet right now, folks, look at it. It's a Federal Reserve note, right? So it's still that same idea of, it's a note issued by a bank, but now it's the central bank. And so that's why we, ascribe to it more magical powers than just if Citibank had pieces of paper that said, turn this in and Citibank will give you 10 silver coins or something. So that's what he's getting at there. And again, I think what he was pointing out is it's not that the government, was in charge of the money supply even. Like that's again, it's hard to wrap your head around it, especially in the beginning, the more, in the pure version from 1792 up until the Civil War. It's not that the U.S. government even decided how many dollars are going to be out there. They just said, if you want dollars, bring us gold or silver and we'll stamp them into the coins and there you go. And that's, you know what I mean? So it was just like the government's not in charge of how many barrels of oil get, extracted.
And it sounds like it's sort of a fraud prevention measure. Like if you're going around telling people, I'm going to give you $1, this officially is what it means. And if you...
Right. Yeah, that's the thing is, I think back then, like when they, in the Constitution, it gives the authority, the authorities the power to coin money and stuff like that and regulate the value thereof. I think that's the exact wording. They didn't mean, in case aggregate demand is insufficient, go ahead and create more U.S. dollar. Like, that's not what they meant. They meant it for commerce to work, people have to agree on what 12 inches means. Like, you can't say, I'm going to sell you this many inches of fabric. And then, but what I mean by an inch is, you know what I mean? Like, there has to be common units and things. Like, that's, I think, the spirit in which they were like, the government has to ultimately be in charge of explaining what the monetary unit is, but not for Keynesian reasons or something. We just, we need to know, what do you mean by it? Like, if I have a contract that I owe Farmer Brown $10, we need to know, what does that mean? Like, what can I do to satisfy that debt? If you give 10 of these silver coins that have been stamped by the U.S. Mint, then that's what, or you give them this much silver. Okay, that's what it means, right? So
I'm fascinated to get in the head of what this, in my mind, establishment economist is thinking. So a little bit after the clip we just played, he says he thinks it would be best for it's a quote, one money system for the world, which sounds spooky, except he clearly wants private money. And I don't think he means a gold standard. It sounds like he is anticipating that gold would just be the money. So, question, if governments were just out of the money business, you could imagine various private actors in various situations having, using different currencies for different applications. So it wouldn't be one money. So I'm just wondering, what do you think Laffer means when he says things like one money system for the world, but it should be private?
Okay, so, and I think as Adams is saying, folks, we're not going to, that particular line that Laffer says is not in we're going to play 2 more clips. I don't think is in there. So we can dive into it. One of the clips, I think the next clip we're going to play is going to touch a little bit on that stuff. But you know what, Adam, do you think you can remember to ask me that again? Because it would make more sense if we play the next clip and I explain that one a little bit, and then I can answer your question better.
Sure.
But otherwise, if we do it in different, I'm going to have to explain a little bit to answer your question here. And then the next clip, I'm going to have to kind of say, remember what I said before?
I can ask the question again. I also want to know what you think he means by an optimal currency area. Should we wait for that too,
Same.
or
Yeah.
All right, let's punt.
I got to
And
teach you the alphabet before I can tell you what a compound verb is. Is a
then
compound verb
let's-
even a thing? Compound noun is a thing for sure. I might have just made that up.
compound bow. That's all I know. And interest, compound interest. All right, here is clip number 2.
So I guess this is my question for you. So you're working at Chicago. You're working at OMB. You're working with Schultz. Going back and forth between Washington. You were there at Chicago in the late '60s, and around that time, you're hired as an international economist.
Yep.
And I'm sure at that time, my guess is you were probably in the same seminars as Harry Johnson. The famous.
Bob Mundell was the leading international economist of the world back then. I worked with Mundell. It's the Mundell-Laffer hypothesis. It's all the stuff we worked together. He was my primary thing. Very big fan of Ron McKinnon's, both of them Canadian, both of them the same economics. He loved my training with Emile Desperry and Ron McKinnon. And we did tons and tons of work together. He took
All three of them were Canadian. Robert Mundell was Canadian. Harry Johnson Canadian. Ron McKinnon Canadian. And some people would argue that part of what inspired the Mundell-Fleming hypothesis or conjecture, and trilemma was the fact that Canada was actually the first to sort of break off from the Bretton Woods fixed exchange rate system in the 50s and to float briefly before they went back.
and it almost got killed.
And that sort of influenced Mundell to start thinking about, should we have a fixed exchange rate regime, floating exchange rate regime? Mundell and Milton Friedman had obviously this, very big debate in that time.
But we were all fixed exchange rates. We were gold standard people. Mundell and I and Paul Volcker in there, and Milton Friedman was floating rates. And just for the record, floating rates don't work. They don't work.
It's a debate that still goes on to this day.
But it shouldn't.
Yeah, well, the end, I guess, of Bretton Woods and the breakdown of the fixed exchange rate system. It's ushered in this.
The fixed exchange rate system didn't break down. The fixed exchange rate system was demolished by sabotage.
Yeah.
We had no problem with a fixed rate system for 3-4 centuries before 1913. It did really well, and it did the monopoly of government and then floating rates did really badly post 1913, and it ended up squirrely as all get out. We almost went back to fixed rates with Reagan. We came very close.
Well, there was the Gold Commission, Schwartz kind of led, and there was a bit of a revisiting of some of these things.
We're totally revisiting, and Reagan was a hard money person, as was Paul Volcker. Paul Volcker was gold standard all the way.
And we got. Volcker wanted a zero to his, for his entire life wanted a 0% inflation target. Volcker.
Me too. Mundell too.
Why? I guess the argument was, why 2% over long periods of time? It's a lot of inflation, but you should have 0%. Instead, was the argument. Was it Friedman who was pushing back and fighting for flexible
100% Friedman
exchange rates, and who won over Reagan in that?
It was 100% Friedman through George Schultz that got the Camp David to go to devalue the dollar, go off gold, and to have the Smithsonian Accord where you go to floating rate. 100% Milton Friedman. Now, there were a lot of other economists who agreed with him, but he was the push. He was the one with George who convinced George to get in there and get the president to go along with it. And, I differed with him on that, very much so, to express it, but George was the most wonderful person in the world. You could disagree with George or whatever without being disagreeable. And as his staffer, the only thing I always wanted was that he listened to me. Not that he agreed with me. I was never elected to make decisions. I'm only there as an advisor, the same way I am with Trump, the same way I was with Reagan, by the way. I'm only there as an advisor. You make the decision, but as long as you listen, I'm fine with you. And that was the same thing was true with Nixon. I disagreed with almost everything Nixon did. Devaluation, going off gold, tax increases, you name it, wage and price controls. But there wasn't a thing Nixon did that I did. But I liked Nixon very much personally. I love George Schultz.
I guess that's why he didn't resign when Nixon closed the gold window. He just liked the fella.
Yeah, it was funny, because again, with working with him telling me that stuff, and I forget, he's like, yeah, we lost. In other words, he was letting me know that, yeah, I was there, and I thought it was a mistake that they went off gold, right? So it was interesting because, seeing him go on CNBC or whatever and talking and doing things like, what's the Fed doing? Should it cut rates or whatever? In that context, it wasn't he was coming out and saying, well, what's the point? Because since they went off gold and stuff, you know what I mean? Like he would just take, okay, here's what the rules of the game are right now, and I'm saying in this framework, this is what I think the Fed should do, or whatever, So anyway, and even as he said there, he's saying, okay, fine, we're not going to target the price of gold anymore, because in a sense, that's kind of what the gold standard was once there's a Fed, is to say the Fed's policy should be maintain the money stock, or ease or tighten to make sure that the price of gold, the market price of gold, stays close to that official rate. Otherwise, our reserves are going to get hammered. But now they don't do that. They adjust the interest rate to do things like targeting inflation, unemployment. And, there he said, yeah, okay, if they're going to do that, then target the CPI, but don't target 2% CPI growth. Why would you do that and make it 0? So, the reason I like that, though, is, to me, I don't think it's accepted among Austrians, like Laffer's version of, yeah, who is the leading intellectual economist behind the Nixon administration going off gold? It was Milton Friedman, right? That's so now, and I will tie it to, there is a Friedman essay, I think it's in Capitalism and Freedom, but I might be wrong about that. But I know I read when I was in high school, I think, I got some pop books once I started getting into econ stuff, and I got, some of Milton Friedman's collections. There's like Free to Choose and Capitalism and Freedom, I think was the other one, the collection of his pieces. And one of them was his case for floating exchange rates. And he just made it a simple example of like why price controls are bad. And so he was like, in other words there, like the context was, oh yeah, some tin pot dictator in South America, and he's running a printing press and his currency's depreciating against the dollar and the yen and whatever. And he just doesn't like that. It's embarrassing. And so he just says, oh, it's illegal. If I catch anybody selling our currency for these foreign ones below this floor, then, I chop your head off. And he can certainly do that. But then, obviously, there's a shortage of the dollar and the yen, and there's a glut of his currency. And then the only way people can get their hands on the foreign currencies is in the black market and paying way above the official rate, right? So that was the argument Friedman made. And of course that's true. And it wasn't until later when I got my hands on some of Rothbard's stuff that I saw the other side. And Rothbard pointed out, Rothbard argued for fixed exchange rates. And what he meant was like the classical gold standard. So here I'll get to your one world money thing. And the idea was, under the classical gold standard, pre-World War I, where they were really abiding by the rules of the game. And after World War I, every power except the U.S. went off gold. Then in the 20s, they came back, but it was bogus. And then that's what led to the problems in the 30s. Okay. But pre-World War I, it was pretty good. Like all the major countries of the world pledged their currency, so the German mark, the French franc, the British pound, the US dollar. They're all tied to gold at a specific weight. And that implied exchange rates between them. Right. So for Britain, it was like 4.25 pounds was an ounce of gold. And you could just exchange it freely. The Bank of England would go back and forth.
Is it the case that that's what Art Laffer is talking about?
Well, we would. I think so, for sure. That's So one virtue of that back in that heyday, as of 1910, is there was a sense in which most of the world was using one money, namely gold. Even though, yes, the people in England would be using pounds, and the people in Cincinnati were using dollars or whatever, you could price as a business person. You could price it. If you bought your raw inputs from Spain and then had them manufactured, in factories in Germany and then sold the output in France, it was like you had the same currency in every place, even though you technically didn't, because the exchange rates were fixed. You didn't have to worry about exchange rate risk, right? And so that was the idea. And so effectively the whole world was using gold as the money with, just like in France, they spoke French. Right, but that wouldn't affect, the money, right? So that was the idea. So I don't know. I would have to hear the clip again, but he did talk about Bitcoin too at one point in this interview. So I don't know, what if he's saying, oh yes, I just want all the governments in the world to go back on a strict gold standard, and then we'll go back to private money and one world money. I don't know if that's what he meant, or he just meant, yeah, get out of it altogether and just let people choose, and they'll probably naturally gravitate towards gold again.
Yeah, I was going back and forth, but I came down on the opinion that he's pretty radical and he just wants freedom, and whatever happens, happens. He happens to think it'll be gold, but probably not everywhere all the time, which is what you'd expect. So that optimal currency area.
Right. Yeah. So that the idea there is, it wouldn't work if every single human being issued his or her own currency, and then we all just try to trade with that. Like, that would be a barter. Right? That'd be like having no money. Okay. Then you say, okay, so does that mean then that everyone on planet, like, given that there's going to be a money, does everyone on planet Earth have to use it, or else does it work? And you say, well, no. If everybody in North America used one type of money and everybody in Asia used a different one, or where, that could work. And then when you do trade between those things, you'd have to worry about the currencies, but that can work. Right. So the question then is, okay, what's the optimal, thing for in terms of what group of people should use one currency internally versus another group, and other pros and cons. So that's what that has to do with. And so nowadays, like most economists, if you ask them, would say it has to do with things like it totally makes sense for the United States to have a common currency because they have, a unified sovereign government over it all. And the reason that you might say, oh, because they can issue, no, the issue is, the reason is that there's unified fiscal policy. That's what they would say, right? That if it's not worth getting into, but that's what they say. Where they say the problem is, like, why some people thought the euro wasn't going to work, because that was part of the dream of the euro, was, to compete against the United States, all these little dinky European countries, we have to merge forces, and how can we do that with all these currencies? And then, the French or the Spaniards are inflating too much, and the Germans are real austere, and this doesn't work, and we got to come together, because how else can we, right? So that's part of the thing. But then the ostensible problem is, but if they're all using the same currency, but then, you can't stop Greece from, running up their debt. And you know what I mean? So that's why they had rules where, if you want to join and use the euro, you got to have your debt to GDP within certain ranges. And you see what I'm saying? Like, the point was, we're not going to let you come into our currency area and benefit. Like, investors around the world will trust your bonds and stuff because it's denominated in this very safe currency, because the ECB is prudent. But then your individual government's just issuing bonds like a madman. Like, so that was part of the issue. And then if there's a global recession, well, then it's tricky. Oh, well, what if, the people in one country are smart and their government runs, counter-cyclical, good Keynesian fiscal policy, and bails their, and gets out of it quickly. But then, there's some right-wing blowhards in some other country that they're not willing to spend money, right? So again, from the Keynesian mindset, that's the kind of stuff. So that's why I say you got to have a unified fiscal region for them to fully tap or lean into the benefits of having a common currency area.
So I'm not missing anything slippery or technical, am I, when I say it's safe to assume that Art Laffer thinks we should end the Fed and central banks are in general a bad thing that should not be? Is that where he's at?
That's, again, he never, that I heard, said it like that back in 2006, 2007. But yeah, from that interview, that seems to be the logical implication of his statements.
That's awesome. Early on in this interview, he was describing his own education, saying that he focused in school on international economics and pure trade and international money. And I'm wondering what you think that focus and study would do to somebody's intuitions about all these various institutions that we don't like central banks and international trade policy, national trade policy, World Trade Organization, the IMF. Do you think that focus sort of led him towards our view of things, or your view of things, and away from like Keynesianism or something more pro-government intervention-y, or what do you think about that?
I could
Given
take
the time that
right.
he was studying, which is like early 60s, I guess.
Yeah, I can take a stab because the third clip that we're going to play for you folks, which is on the longer side, is where he, among other things, he tells the story of how did he stumble upon what we now call supply side economics. And so the way he tells the story is he used to be a standard Keynesian, and then he was just doing the econometrics, just trying to estimate like the multiplier from government spending and blah, blah, blah. And just the numbers, it wasn't coming out the way he expected it. It seemed like, geez, it seemed like government spending really doesn't do that much. And he was like, what the heck? And then it was only by him just trying to, he's checking the dials and I'm exaggerating a little bit, but he's making it like first he thought he did something wrong. And then he just, no, that's the number. What the heck is going on? And then he had the epiphany and like, oh, wait. And I won't spoil the surprise. So I'm just saying, Adam, given that that's the way he tells that, and that would have happened after, right? That was like once he was working in the government and everything. And so I think you're right that I think what he means by like saying pure trade and whatnot is like you have models that don't originally have currencies involved. Like you just start from, this country here is selling wheat to these people over here and they're selling oranges back and forth. And this is and then start making assumptions about whatever transport costs and things like that. And, what if things, if some goods are perishable and then what happens and blah, blah, blah. Right. What if labor's mobile? You can start doing stuff like that. And then, you can get some basic results and get your intuition down. And then you can overlay currencies on top of that and then start talking about exchange rates and how does that do. But it's very pure in the sense that you're from coming from that perspective. And he's talking about Mundell and Fleming and things like that. The idea is like, this is a good example. If you're saying, why does the U.S. have a trade deficit with the rest of the world? And instead of looking at it like, well, why do we want to buy more of their consumption goods than or their goods than vice versa? Instead, you're saying, well, look at the capital flows. No, it's the rest of the world wants to invest more in the United States. Then the only way to make that happen is if we have a capital account surplus, we got to have a current account deficit. So basically, if they want to load up on our treasuries and real estate claims, they got to send us Toyotas to pay for it, right? So you're not thinking in terms of the money. The money's like an afterthought, like to make everything balance out, like the books to settle. But the idea is the underlying claims and trades and whatever are like in a barter sense, right? Or for just financial assets moving around, and then you just again lay the money on afterward to say how do you go do this in practice? So I think that's what he meant. But then, given that that's the way he would think, that I think it makes sense that these things just get in the way. Like, no, there's this elegance, and look at all these results, and it's cool. And so, just governments get out of the way and just let people do these win-win trades, and look at how cool this is. Right. I think there is that.
All right, so we've got one more clip. Anything to say as a prelude?
Just kind of what I was going on. That here, he is going to tell the quick story of how did he, stumble upon. Let me just mention it because I threw that term around. So supply side economics is what the label that was given. So Laffer is a huge name in this field, and the Laffer Curve is a big deal. Jude Wanniski is one of the pioneers in this in terms of like popularizing it. And then, the Ronald Reagan tax cuts when he first came into office, the Kemp-Roth tax cut act or whatever, that is like, oh yes, the revolution was won, the supply, and then boom, the 80s were awesome and supply siders for the win. That's kind of like the way right-wing Republican supply siders would tell the story. And the reason they chose that title is to distinguish themselves from demand side management, right? So in the Keynesian view, if you got the economies in the doldrums, it's because there's not enough aggregate demand. And so we got the government should run a bigger, the central bank should cut interest rates. And you say, why? Because we want people to spend more. Because if businesses aren't earning enough revenue to fully employ the workers, then we're going to have unemployment, right? That's the way the Keynesians think. And then, if inflation's getting out of control, it's because we're spending too much. So we got to sop up demand. So raise taxes or cuts. But the idea is that demand is the lever that they're moving back and forth. And the supply side insight was if marginal tax rates are 70%, well then, people, I don't care how much the government's spending, and no one's going to want to produce, right? Because to have businesses produce stuff, somebody's got to be making a profit. whereas you reduce marginal tax. And one last thing I'll say on that is, with his work, he was showing the higher that you start out with that marginal tax rate, the bigger deal even a slight reduction is. Like if you started out and a marginal tax rate was 90%, right? So any income above $200,000 gets taxed at 90% on the margin. If you just cut that to 80%, you've doubled your after-tax income, right? Because originally you got to keep 10% of whatever you produced, or you can keep 20%. So in other words, that's doubling the rate of return in terms of like how many hours you're spending at your restaurant or something. If you make over 200,000, and to say, oh, imagine getting to keep twice as much, that's a huge, relative change, right? So that was some of the insights that saying when you're starting out with these really high marginal tax rates, even just slight reductions are going to have a huge impact. And so then the idea was, this is the Laffer Curve notion, if you expand the base more, even at a lower percentage tax, you might actually bring in more total revenue. Okay. Or at least there is that trade-off. And so, a tax cut might not be as bad on the budget as you would have thought.
Right. And the curve being 100% tax rate, you're going to get zero. And at zero, you're going to get zero. And somewhere in the middle there is a shape that has something to do with human psychology and how much people are willing to work given a given tax rate. Yeah,
so since you said, I'll just mention. So the story is, and what's funny is Laffer himself later said, he wasn't saying it didn't happen this way, but he couldn't independently remember. I think it was Jude Winniski wrote it up, in a book chapter or something, saying, so a bunch of them were at some dinner, and it was Don Rumsfeld and Laffer, and I think Winniski was there, and maybe some other people. And Laffer's just trying to get this point across. And so, he takes out a napkin. In Laffer's office, there's a napkin there, right? And I don't know if that was supposed to be the original one or he just redid it or something. But the idea was he's trying to explain it, I think, to Rumsfeld. I could be wrong. And just to get, like you said, to get that point across, he draws the axis and has the tax rate on one and revenue on the other. And he said, yep, if the tax rate's 0%, how much revenue are we bringing in? $0. Okay. If the tax rate's 100%, how much revenue are we bringing in? And you think a second, well, why would anybody work if they have to give everything to government? So also you'd get zero, right? Okay. And so then he just kind of drew a simple, curve connecting those two, which would imply, at some intermediate tax rate, revenue's maximized. So, and then, if the tax rate's higher past that point, so it's called being like on the good of the prohibitive side of the Laffer curve is like the terminology. So to say, right now, are we on the prohibitive side of the Laffer curve, then that means you could lower rates and total revenue goes up. Right. It's one last thing I'll say around this. Laffer never said the optimal rate is the one that maximizes revenue to the government. So clearly he would agree it would be stupid for the rate to be higher than that, right? Because then you're taxing people, taking their money away for no benefit, in terms of the Treasury. But he would have been okay with lowering the rate, on the better side of the Laffer curve, if revenue went down. But even there, his point was revenue will not drop as much as you think it will with a static analysis. Right.
Do you happen to know if he ever said that explicitly?
Oh, totally. Yeah, he did. Okay. And he wasn't just saying it after the fact. Like when I, first started working with him, I went back and read all of his early papers and stuff. He said that before they did it. You know what I mean? So it wasn't just like, revenue went down and he was covering himself. And by the way, revenue went up too in the Reagan years, right? So it's...
No, but I mean, did he ever explicitly say, I for sure don't want us to be here at the optimal intake for government. We have a better society if we go shrink government spending and go and tax even less.
I'm virtually sure that he did explicitly say that. I'm even more confident that he never said the optimal rate is the one that maximizes revenue. Like, gotcha. I'm virtually certain he never said that anywhere, and I'm pretty sure he did spell out and say, at the lower rate, like, where should they set it or whatever. But that's the thing too, is that wasn't just a shtick that he was doing. Like, he really did view himself as just like, hey, I'm just advising, I'm not a dictator. Nobody elected me. So there's a sense in which he could say, well, that's a very what should the tax rate be? That's a very complicated question. But his point was, let's think about it the right way and don't just think, we got to get more revenue, so we just got to increase the tax rate. Well, that was the thing too, is even there I'm being more careful. The way people normally talk is, so-and-so cut taxes. And he just thought that was too ambiguous. Like, what do you mean by that, right? Do you mean he reduced the tax rate? Because it's possible tax revenue went up.
Right.
So is that a tax cut or is that a tax hike, right? So,
gotcha. All right. Well, this is a bit lengthy of a clip, so let's dive right in.
Government spending using the seasonally unadjusted co-adjusted. You can go back and look at the article there. It created huge kerfluffle in the world. If you go back and look at the article there, I found that government purchases of goods and services increased GDP by the amount of the increase in purchases of goods and services in the first quarter, and then for the next 3 quarters went back down to where it otherwise would have been. So it was 100% crowding out of shifting government for there, and I couldn't understand that. And government transfer payments actually reduced GDP growth. So I was struggling with this, being trained as a macroeconomist back then. I was struggled with this terribly, and finally came to the conclusion it's incentives and supply. If you tax people who work and you pay people who don't work. Do I need to say the next sentence to you, John? No. That was supply side economics. When government spending reduces output, not increases it. Taxes are a disincentive to work output and employment. Transfer payments pay people not to work. They tax people who do work. And that was the evolution of supply side economics, which is the exact opposite of Keynesian or monetarism. I am not a monetarist at all. I'm not a Keynesian. I personally believe that people don't work because they're jobs. I believe that people work to get paid, and they get paid after tax. I don't believe that people save their money because of their incomes being higher. I believe they save their money to make an after-tax rate of return on their investments. Hello? It's an incentive-based model. I believe that if you have 2 locations, A and B, if you raise taxes in B and you lower taxes in A, producers and manufacturers are going to move from B to A. You know, people can change the location of their income, the timing of their income, the volume of their income, and the composition of their income, all based on taxation. And that came out of my paper in 1972. And I was at 6s and 9s. I was completely at odds with my own concept until all of a sudden this classical model started rolling in on me, and bang. And then you can see all the rest from that. Mundell was right there with me the whole time. It was just a great fun. And that's why now I spend so much time on macro. It's just incentive economics, John. That's all it is. I mean, nothing more, nothing less, just like international economics.
Absolutely. You know, and it's fascinating. I think there's now, or roughly 50 years later, I think there's a whole renaissance going on in fiscal research, and a lot of work done by Valerie Ramey here, and work done by John Taylor as well. Just showing that fiscal multipliers are much smaller than people I think
they don't exist. They're negative. They're negative, John. They're negative. Have you ever heard of a person spending himself into wealth? It's stupid. Have you ever heard of an economy taxed into prosperity? It makes no sense. Now, there are certain functions that government does that it does better, like military and stuff like that. We're not talking about that. We're talking about transfer payments. We're talking about that. And can I go through with 1 second with you on the transfer theorem? Because this is so important, John. The transfer theorem is that all transfers are where you take income from one group and give it to another group. That's a transfer. We usually think of it in terms of from those who have a little bit more to those who have a little bit less. You with me? Mm-hmm. Now, if you take from those who have a little bit more and give to those who have a little bit less, by taking from those who have a little bit more, you reduce their incentives to produce, and they will produce a little bit less. By giving to those who have a little bit less, you provide them with an alternative source of income other than working, and they too will produce a little bit less. The theorem here, and it's a theorem, it's not my opinion, it's not I'm tall, I'm short, I'm Harvard, it's math. Whenever you redistribute income, you always reduce total income. And that's the whole basis of stimulus spending is redistribution of income, and it doesn't work. It always reduces income.
I mean, my sense is that, having looked at a lot of the myself as well, and this is the arguments that John Taylor and Valerie Ramey others have made, is that really the challenge with transfers is that they largely get saved and they don't get spent. So this idea that like, well,
the truth.
people
That's wrong. Let me just say the problem with transfers is they have to be taken from someone else.
Well, that's true too. I mean,
no, that's not true too. That is all that's true. By taking from people who have, you reduce their spending because they now have less than they otherwise would have had. That will destimulate the economy in the same way the people who receive the money will spend more. The recipients of transfer payments will spend more. That's true. But the payers of transfer payments will spend less. The income effects. Get your Slutsky equation out. This is where training today is so bad. Get your damn Slutsky equation out. And in an economic system, the income effects always, for a transfer or a tax rate change, always come to zero. Always. But the substitution effects don't. I had this problem with Senator Nelson in 1974 when we were talking about the $600 tax rebate from Jerry Ford, that guy. And, I was trying to explain the substitution effects to the senator, and I couldn't find it. I said, and I was testifying with Gardner Ackley, Paul McCracken, and Otto Eckstein. Okay, they were the three senior grown-up economists who really wanted to do this transfer. And finally, I said to the senator, I said, sir, if those three economists are correct, that $600 stimulus will increase output, employment, production, what the hell's the matter with you? Why only do $600? Why not 6,000, 60,000, 600,000, 6 million? Why not 100% of GDP? So everyone who produces and works receives nothing, and all those who don't work and don't produce receive everything. What do you think would happen to GDP? And he goes, God, it would go to zero. And that's right. And these guys just don't understand straight up from Sikkim. A transfer system, a la Keynesian, is you take from someone and their spending goes down. You give to someone else, their spending goes up. That's true. That's a zero-sum game. But the substitution effects make it a huge negative-sum game.
Bob, Art Laffer there used a technical economic term that I'm not familiar with. Can you define for us?
Yeah, that was the Gerald Ford impression. Yeah, so that was just for people. I love that clip because the kid just kept coming. I don't know how old he is. He at least twice just kept trying to come back. Well, right, the multipliers are lower than people. And he said, no, they're zero or they're negative. And anyways, that was funny. And then the other one too, was when he said, well, yeah, that there's that issue too. And he goes, no, not two. That is the issue. In other words, the kid was trying to slap on the stuff Laffer was saying as an afterthought. No, yeah, we shouldn't lose sight of that. And he's like, no, that is the whole thing. What I just said is right. This is a dumb idea, so we got to grapple with that. So let me just, the reason I like that is because I think he's right. And again, the way he tells that story, it's not that he went in knowing, oh, I'm a right-wing Republican and I want it to be that government stimulus spending doesn't work. And so, what kind of theory can I come up with to backdate and, give me these answers that I want? That's not the way he tells the story. It's that at first he couldn't understand how can my econometric analysis be getting these. And by the way, in case people are like, well, he's the first one that used econometric. He did it differently. So for, among other things, he didn't use seasonally adjusted data because he thought those seasonal adjustments, it's not letting me see the real numbers. They're already taking it and massaging it and imposing some assumptions. And so he would do his regression analysis and whatever using non-seasonally adjusted data. And so that's just one thing to show why is it that he was getting different estimates compared to what the other people were doing. All right. So, he had, what he thought was the right way empirically to go ahead and assess this stuff. And Laffer is a sharp guy, right? So in case people are like, well, I just see him hobnobbing with presidents or, right-wingers or something and Larry Kudlow, and how do I know that you're telling me he was better than the guys at Harvard? And he was got the tenure at Chicago faster than anybody in history in the economics department or something like, what I mean? So yes, he was an impressive guy. If you talk to him, he's really intelligent. And so I don't think he's bluffing there. I think that he really did come up with a better way to assess the multiplier, if you want to use that language. And he was showing, and notice he said two separate things. He didn't say when the government spent money like building a bridge that there was no impact. He said, oh yeah, you could see it. If they spent $10 billion building a bridge, GDP that quarter would be 10 billion higher, but then it would go back to what it otherwise would have been, right? And so the idea is, that's what he's saying, that there was pure crowding out. So yeah, the government can build stuff and that's real and those people are getting paid, but that means, that must have been, those resources were coming from somewhere else. And he was seeing that empirically. Whereas with the transfer payment, so there it was just more of like, yeah, you can have a bridge, but then it means you got $10 billion of less stuff from the private sector, which kind of makes sense, right? Those resources came from somewhere. But he was saying with just pure transfer payments, he wasn't seeing anything. It was like a negative thing. He was like, what? And that's where he was then later realized, oh, that does make sense. And, I don't need to belabor how he just went through it with that guy. Let me just say that I saw this beautifully illustrated with the so-called Obama stimulus package. So real quickly, folks, I don't have the numbers off the top of my head, but it was Christina Romer and Jared Bernstein were the chair and vice chair of Obama's Council of Economic Advisors. Remember, there's the financial crisis in the fall of 2008, and Obama wins, that election, November. So he's sworn in coming in to, January 2009. The economy's in free fall, and so he has his so-called stimulus package go through, and the Romer-Bernstein analysis, that came out early 2009 as to why we need this stimulus package. It was saying, here's unemployment right now. I think it was like 7% and change, and said, if we get this stimulus package in place, it will limit it. Again, I'm making these numbers, something like it'll go up to the high 8s or something. And if we don't put the stimulus package in place, then it'll go to 9.5 or something. Again, I'm making those numbers up, but it was something like that. So we went ahead and got the stimulus package, and unemployment broke 10%. Okay, so unemployment was worse with the stimulus package than what Romer and Bernstein were warning. Hey, we better do this because if we just let the free market prevail, unemployment might go up to such and such. And so I'm saying with the package that they wanted, or that they, the version that went through and got passed, unemployment was worse than what they warned would happen if we do nothing. So you would think, what more could you possibly see to say maybe this thing made it worse? Of course, that's not what the Keynesians said. They said, well, it's a good thing we passed even that modest stimulus package because the economy was in worse shape than we thought. If we hadn't done that, actual unemployment would have gone to 14%, right? In other words, and that's the thing too, like even after the fact, like 2 years later, they would come out with assessments of how many jobs were saved or created, right? That was like the phrase that people on, right-wing commentators were laughing at that, like to say a job was saved or created. Well, okay, that's kind of like a non-falsifiable thing, right? So that's what I'm saying, that they came up with all these positive estimates of the Keynesian multipliers, and as people pointed out at the time, critics, like guys from the University of Chicago and stuff, saying there is no universe in which they would have looked at the numbers and said these multipliers were negative or that the stimulus package didn't do anything, right? Like just the constructed, the way they did it is they assumed the way their model worked is government deficit spending necessarily makes GDP higher than otherwise it would, necessarily makes employment higher than others would have been. And then they were just trying to assess using various techniques, right? So there was some method to it. They weren't just throwing a dart at the board and reporting the number. But the point was their techniques would never, no matter what the numbers said, have popped out and said, oh, you know what? We actually made things worse. That was literally impossible that could have been the answer popping out of their result.
Falsifiable. Yeah, for sure. I don't think Art Laffer is guilty of the same thing, but I do wonder. A lot of the things he was saying as he was describing them are, what we understand, incentives matter. We can predict this sort of thing from basic human psychology or whatever. So do you think his empiricism is driving his theory, or are they disconnected, or is one like a double check on the other, or how do you think it works for someone with that approach? Because he's not an Austrian, right? He's something different.
Right. Again, I think he would call himself a supply sider. What's funny too is he said there's something like in that old classical approach or model. He might even say the word model. I don't remember reasons. I think there's a sense in which he considers himself a classical economist in the sense of, you know, that there are a lot of truths that those guys discovered, and, you know, and he's bringing that forward. Again, all I have to go on here, and I don't have any special insight from working with him beyond this, is the way he tells the story is he was not, you know, baptized as a free market, laissez-faire guy. He had his standard training, and then it was him sitting there being puzzled by his empirical estimates that he couldn't figure out, how can this be? And then it was only later realized, oh, wait a minute, I can make sense of that. You know, so again, I had that thing too with, because once I saw what happened with the Obama thing on the front end, then there was a similar thing later with the so-called sequester, right? That, you know, the Republicans, was it in 2010 that they did well in the midterms, you know, and then they were forcing, they had like the government shutdown and stuff like that. If you remember all that stuff going on, you know, Krugman was calling it, you know, making Dr. Strangelove references and saying it was a doomsday device that you know, except that it's the Republicans are doing it, whatever, you know, rhetoric like that, like, cause they're going to just, you know, slash spending and whatnot. And so it was the guy, oh shoot, it was the economist in Moody's, I think, and I can't think of the guy's name right now. He's got, like, if you listen to NPR and that kind of stuff, like, they would quote this guy all the time. I can't think of his name right now, but he had an analysis of showing how bad this sequester is going to be. And here it wasn't unemployment. I think it was GDP growth. And he was saying, if this sequester goes through, you know, GDP growth is going to be this awful number. And if we just keep things as they are, then it'll be this decent number. And so we got the sequester, and GDP growth was higher than what he said. As long as we don't get this bad sequester, GDP growth should be such and such, right? So again, on the front end and the back end, the outcome, the Keynesians were saying that, like, the data could not have said they were wrong more. And in this case, what they said is, thank goodness the economy was in stronger shape than we realized, so the sequester didn't hurt as much. Like, the economy was either able to weather that, or some of them said the Fed offset it, and that was their, you know, get out of jail free card. But in any event, I'm just saying you saw that same pattern. But, like, I could see that easily because I was able to step outside the paradigm. But no, those guys all were locked in, and they're just going around reporting matter-of-factly that, well, yeah, those idiot Republicans, do you know GDP growth was this much lower? Even though the absolute level of GDP growth was higher than what they had said. They didn't care, because we all know, it's just like they're acting like they're going out and taking the temperature and telling people what's the temperature outside. Yeah. You know, when no, that's not what they're doing when they say, because there's always a counterfactual. If you would say, you can go measure GDP, but the issue is GDP higher now or lower than what it would have been had this policy been different? And there, you can't just go measure that. It's not out there. It's an alternate reality that never occurred now.
At the end of that last clip, you heard him vent some frustration on the interviewer. And then earlier, as he was talking about his upbringing, he said back when he was being trained, they were, quote, a lot more rigorous back then. Do you know what he means exactly about rigor in that sense?
Well, so there, yeah, the specific thing he said there is like, get out your damn Slutsky equation.
Yeah.
And so what's funny is I always remember the Slutsky equation because my micro professor at NYU, who's just real anal, like, he was the most rigorous guy I'd ever met in my life up to that point. Like, that's when I first was disillusioned with the Austrians, because I thought, like, they lied to me. Or, you know, when I was not expecting these guys to be a bunch of buffoons. And it was like, holy cow, these are the smartest guys I've ever met in my life at NYU the first year. And then it was like later I was like, oh no, they're crazy. They actually believe these models, right? So that's right. I came back and, you know, so no, the Austrians certainly are wiser than these guys, even those guys are like, you know, technicians and are really intelligent with math. And he's writing it on the board. And he actually said, my first love, the Slutsky equation. And he wasn't making a pun about, you know, slut. So I just want to clarify.
Yeah, I got you.
So, and that one, the idea is if prices change, you can decompose it like, okay, so you have a certain income, like measured in money terms, and then, you know, there's various goods you could spend your money on. And then the idea is, what if other things equal, one of those goods gets cheaper? And so then, you know, how does that impact how much you spend on all the different goods? And so the idea is, well, by one good getting cheaper in money terms, there's two impacts on you. On the one hand, there's what's called the income effect, that your real income, you're wealthier now, right? Given how much you get from your paycheck, if one good out there now is less per unit, there's a sense in which your paycheck goes farther. So there's that sense. And so you might spend more on some other good just because now you're wealthier, right? So there's that issue. But then the other issue is now, given that good is a lower price compared to the other ones, there's a substitute. So that first thing is the income effect. And then the second thing is the substitution effect, that now as you allocate your dollars among the possible goods, the fact that one's cheaper than it was before clearly means you're more likely to, buy more units of that. You don't have to, but there's a bias towards that, right? So that's the substitution effect. And then the total overall effect, and how do you actually reallocate your dollars, is like the sum of those two effects, right? So that's what the Slutsky equation spells out with calculus. And so that's what Laffer was getting at there, is saying, this stuff about the multiplier and you got to do this, and like, oh, that was the thing the kid said too. He said, well, the issue is with transfer payments, people might just save it. So from a classical point of view, do you see how backwards that is? To say, oh yeah, the reason taking from producers and handing it out to people who aren't working, I'm exaggerating, but you get what I'm saying, high income people to low income people in the limit. Save it. Right. And to say the reason that might hurt the economy is because these people won't just go to the mall and blow the money. They might save it.
Because as we all know, saving is just terrible for a capital-intensive economy.
Right. And so you can see why Laffer, was having a stroke when the kid said that. Like, no, you're totally missing it. That's not the issue. That's not the problem. Right. So, because from a classical perspective, like, given that the government is taking money from the producers and giving to these people, actually probably the best thing they could do is save it. You know what I mean? Like in terms of promoting long-run growth, that's what you want to do, not go buy, candy corn with it. Okay, so yeah, so what he was saying there is that kid, when he was just blowing through that and not really listening or thinking, oh yeah, you're talking about folk wisdom, or so this is the kind of stuff that I could hear if I listened to Fox News. But here I'm talking about, multiplier estimates and stuff. They got the p-values and the 2 stars and the thing and the regression. And Laffer was like, no, don't you get it? I'm not just saying, worldly wisdom from Proverbs here. I'm saying this is technical economics. This is the Slutsky equation. Get that out and look at it and get what I'm telling you. Right? So I think what he meant in terms of it used to be more rigorous or whatever is, one thing is, the further back in time you go, the smaller were the class sizes, right? Mm-hmm. Well, for a place like Chicago, so maybe the class size is the same, but more people are getting their economics PhD in 2025 than in 1960. Mm-hmm. Even like as a share of the population. Obviously, the absolute numbers are bigger, right? So it was the programs were just harder back then. Like I've seen examples. People have posted stuff like the final exams from Milton Friedman's classes when he would teach his students in Chicago, like in 1965 or something. And it was like, holy crap, I'm glad. Like that would have been almost somebody's dissertation to answer. I mean, I'm exaggerating a little bit, but like, no, those questions were tough. And it was like amazing. Like that, it wasn't just like a semester project. That was, here, you come in, you got 3 hours, knock yourself out, or else you fail price theory. So I'm just saying that I think that's partly what he's getting. So yeah, technically, like I know what Slutsky's equation is. And like I said, that guy taught it to us, but I had to go look it up on Wikipedia after Laffer said it just to remind myself what it was. Like that wasn't like seared into my brain. And like,
not rigorous enough, Bob. Not
that's what I'm saying.
Enough.
And NYU was a top 20 in the world when I went through it, maybe 15. So I went through a decent program, but I'm just saying the standards got whittled. Like they used to, like Kerzner explained this. So I took him, the only class I ever took from Kerzner was History of Economic Thought. And there it was only offered at the master's level, right? So I'm sitting there with a bunch of master's students because, I'm here. I want to catch an Israel Kerzner class while I can. And he explained it. Oh, yeah, when he went and got his PhD, it was just like that was to get a PhD in economics, of course you had to take, I think he was saying at the time it was a 2-semester sequence on the history of the discipline. And you go read those older guys, and it's partly a selection bias that the old people you read are like the masters, otherwise you're not reading some schlub. But just listening to them, they were like, it just seems like they know the whole history of the discipline, Whereas some people now, like, they almost flip it and say, well, geez, why would I waste my time reading something from an economist in 1910? Like, that's so stupid. Like, anything good that they had would have been maintained and would be in the latest, I should just go read the latest econometrica and AER. Right? So,
I get it. I hate it, but I get it. I just got a couple more questions.
Sure.
They're sort of scattershot. At one point, Art Laffer says that Reagan's 1986 tax bill was, quote, the closest thing to God in heaven we've ever had. Was he right? Was it really that good? Not just, from everything that came before, prior to 1913, but everything after? I mean, was it really that much of a high water mark as far as decent tax policy in America?
Let me just preface this by saying that's something that I got from Laffer. Oh, by the way, I had said at the start, as I don't want to fail to live up to that promise. The stuff that Laffer did when I worked for him about, like, the current account, like a trade deficit is really, the real thing would be a current account deficit. That's kind of the issue. And the distinction is, let's say people in the United States lent $1 billion to somebody in Japan, and it's at 10% interest, right? So then every year those people owe $100 million interest payment to the United States, right? You with me?
Mm-hmm.
And then what if the people in the United States used $100 million to buy Toyotas every year? And that's how it worked. So every year, given the story I just set up, every year you would see a flow of Toyotas from Japan to the U.S. with no goods flowing the other way because of that original transaction. And it might, and so that would be a trade deficit, but it wouldn't be a current account deficit. All right, a current account means like adjusting for the income flows and whatever, right? So what people mean by, like, oh, if we're sinking deeper and deeper into our indebtedness, like, oh yeah, we just keep sending over more, like the Japanese, they just keep lending us more and more money, and we use it to buy more and more Toyotas, and then the amount that we owe them just keeps going up. Then that would be a trade deficit and a current account deficit, right? So anyway, just that kind of stuff, and to say, like, well, geez, if people around the world, like, what if just the U.S. real estate market's really hot and people around the world want to get exposure to it? Well, then that could, you'd see that other things equal in the trade statistics. Oh yeah, they would have a bunch of goods flowing into the U.S., right? Or I recently said, if Elon ever gets his Martian colony, in the beginning, there's going to be humongous trade deficits of Mars vis-a-vis Earth, right? Because a bunch of goods are going to have to flow here, there for them to set up the basketball courts and the hotels and the observatories and whatever. The basketball, because you can really jump high with Martian gravity.
I get it.
Right. I know you did, but people at home, right? So anyway, I'm just saying, and so just thinking through stuff like that, does that mean that there's some problem? Like, no, obviously that's what you'd expect. In the United States, the first few decades, there were huge trade deficits, particularly in manufactured goods, right? Which made sense. It's this new thing, and and yeah, all the established capital in Europe's going to flow there. Okay, so I'm just saying, me understanding how that stuff worked, it was working with Laffer, and I can hear, he was with Bob Mundell, was the world's leading trade economist and such. All right, so anyway, there's that, but then also with the impact of taxes and whatever, yeah, Murray Rothbard and Mises are against taxes, obviously, and they understand incentives and things. But I'm saying that the stuff Laffer was doing, like even the thing I walked you through before, Adam, about if you started at a 90% rate and then reduced it to 80, that actually doubles your after-tax return, stuff like that. That, it's obvious, but I had never seen that spelled out in the Austrian school. And so with all of that stuff, that yes, I think the proposals and like the idea of why a flat tax is better than, a steeply graduated progressive tax, things like that. I think sometimes Austrians don't fully appreciate that. And so in that respect, that's why Laffer likes that 86 Tax Reform Act so much. I don't remember the details off the top of my head, but it lowered
something about like maybe only 2 rates and slashing out a bunch of the loopholes. So
right.
It's straightforward and not distortionary.
Yes, because the idea is, and I know Rothbard was really against this, this mentality. I don't remember if Rothbard said whether yes or no do I like the 86 Tax Reform Act, but he Rothbard likes tax loopholes. He said, I want them to be, loopholes big enough to drive a Mack truck through or something like that. But the logic of, what Laffer's talking about, why he loved that 1986 act was the idea is that, because they really don't like high marginal tax rates because of the disincentive effect. And so the idea is, all right, well, so instead of having it, the top rate is 50% and then the next one's 40 and 30, if you could get them all down to 18%. And you can have a standard deduction too. So, right, so it's not like homeless people got to give up the same amount as a billionaire, but you can have a standard deduction and then just a flat rate. And so effectively that's kind of like two rates if you want, like 0% up to a threshold and then the 18% or whatever the number is above that. Yeah. But the way to, you say, but the problem is if we make the rates too low, well, then the government's not going to get enough revenue for all the stuff it needs to do. And so the way you handle that is, okay, the way to get the rate as low as possible given the targeted revenue is to get rid of deductions and loopholes and stuff like that, credits and things, just to say no. And the logic of that is to say, I'll do it this way. Given how it is, it's problematic because, to take away a loophole, you're necessarily raising taxes on somebody. So if taxation is theft, you can't do that. That's immoral. But if you were starting from no tax code and had a gun to your head and you had to design a way to say the government needs $1 trillion a year, figure it out, and you can tax income, it would be silly to have really high marginal rates and have a bunch of loopholes and things, because then that's really distortionary. And then it's like the politicians are steering investment into, if we have, tax credits on green energy, and if you get an electric vehicle, then you get a $2,000 rebate, and and it's they're just directing things, and that's inefficient given how much revenue the idea is the economic cost in terms of forfeited output to raise a certain amount of revenue is higher when you have a code that's got all those wonky things in it. If you just had a flat rate with no deductions and everything, then you'd raise whatever the target revenue is, and real output would be as high as it could be given that much revenue is flowing to the government's coffers. That's the argument.
Gotcha. All right, I have two more questions.
Okay.
These are both things that Art Laffer said, and he was emphatic about them both. And the question for each is yes or no, is Art Laffer right? So the first one is, does God have a photo of Ronald Reagan in his office?
Yes, but that's just because God has a photo of everyone, because God has everything.
I knew you were going to say that. Next one. Will Democrats start adopting Trump's policies because they're so effective?
That was interesting. So near the end there, the kid's asking him political stuff, predictions, and he was saying that the only way the Democrats are going to be able to counter the Trump revolution is to get on board. And when he said that, it sounded implausible to me, because he's like, this guy's Hitler, but his economics are pretty good. But number one, they actually believe, you know what I mean? Like, they are socialists, so why wouldn't they be national socialists?
Right.
But also, you do see it in the sense of, like, I never would have thought I'd see Democrats talking about the virtues of free trade. But they do when Trump is talking about tariffs, right? And so, and just like how they flip-flop on, there's all those clips of like Clinton and Bill Clinton and Hillary Clinton stuff talking about borders and stuff. Sure. It sounded just like Trump today. And like back then, I was like, yeah, totally. So, there is all that. And so I guess when I first heard him talking like that, I recoiled and thought, no, I don't believe that. But I think he's right in the sense that the Democrats are going to just do whatever they think they need to do to win, to get relevant again. Because, right now they're just in shambles. That realizing to just keep saying, what we are is what we stand for is we hate Donald Trump.
Right.
That's not working.
It's not a policy.
Right. So I think, and also, like, I don't think he got into this stuff there, but what they're trying right now is going full socialist with Mondani and whatever, right? And he's helped, I think, because of the foreign policy stuff getting all mixed in there. But I think, if he
and also having Cuomo as his main opponent.
Right.
Good Lord.
Right. So I think if he gets in there and does that, then that will be a good experience. Like, I think it's going to blow up in their face. And then, that will remind people. So I think then the Democrats are going to have to learn, like, oh, yeah. And so, like, if it's AOC or whoever because what's his name? Is it?
Gavin Newsom?
Newsom. How about I just call him Newman? I was like, no, that's the guy from Seinfeld. He's just saying whatever the heck comes, you know what I mean? Like, he's saying all kinds of, he doesn't have any fidelity to democratic principles, or he's just saying whatever he thinks is going to fly. So he would have that guy would get up there and talk about the gold standard if he thought he'd become the president. He had no principle objection. So, like I say, this is my long-winded way of saying, at first I thought Laffer was nuts when he said that, but then I thought about it more, and I said, maybe he's crazy like a fox.
All right. Well, I don't have any more questions. It was a fascinating interview. I'm glad we covered it. Did you have anything more?
Again, for people who like like even if you're the kind of person who just likes U.S. history and stuff, Laffer does get into some inside baseball with, there's this administration, we did this, so you might want to look at it just for that reason alone. It's only like an hour and change. It's not a long interview.
Yeah, we'll link to it. All right. Well, thanks, Bob. This was awesome. If you good folks are listening to this on Haman Nature, God bless you. I love you. Please go check out The Bob Murphy Show. And if, as is more likely the other way around, please go to my Substack at hamannature.com, Haman, and check out my YouTube page. Hit all the buttons and cling the bells and the whistles. And thanks for teaching everybody smart things about economics, Bob. And,
well, before you joined, this podcast used to be rigorous. So.
Now it's not. All right, buddy. We'll catch you next time. And we'll catch all of you next time.
Thanks, everybody.